Hello, and welcome to the November 2024 edition of the U.S. Energy Insights. I am your host, Pamela Munger, and I'll be looking at the latest trends and market conditions within U.S. and global energy and sharing actionable insights powered by Vortexa's tracking analytics. In this insight, we will touch on global crude loadings and inventories, the TMX impact on Aframaxes, the Dangote gasoline production update, a look at transatlantic clean product flows, supertanker cleanups, and finally, a brief look at Trump's election impact on the energy markets. Now let's start by looking at global crude and condensate liftings, which we see in the middle of the seasonal range, tracking below 2023 levels with a similar seasonality pattern amid a backdrop of low demand. Now, if we ask ourselves why prices are not even lower than they are, we can then look at the right-hand side chart as the first indicator and see how much certain regions have cut. The Middle East and Europe are especially notable, while rises are only seen in the Gulf of Mexico and South America to a large extent. Now, if we take a look at global crude in tanks and tankers, we can see even more of a reason why prices have not moved downward further. Inventories are at the bottom of the seasonal range as designated by the red line. This is also true for floating storage inventories as seen on the right-hand side chart, which have been drawing since the beginning of the summer. We track inventories for 110 countries around the world, including China. Now, looking at the latest in the TMX opening, we see even more heavy sour Western Canadian crude is absorbed by PADD 5 in the seaborne export market or sent to Asia. This has led to a loss in market share in PADD 5 for Colombian heavy sour crude. Now, as a result, more Colombian crude has headed to PADD 3. Now, moving forward, this presents an employment opportunity for the America's Aframax market, which has had to contend with increasing competition from Suezmaxes. Now, when the Dos Bocas or Olmeca refinery, which is 340,000 barrels per day, starts and reduces heavy sour Maya crude loadings at the Dos Bocas and Pajaritos terminals, PADD 3 could increasingly look to Colombia as a supplier. Now let's get the latest on the Dangote gasoline production. We have been watching closely, and in our platform, you can see that gasoline liftings in the lime green color have been increasing since October, while fuel oil loadings are decreasing, indicating a ramp up of the secondary units. Now, at the same time, you can see on the right-hand side chart that November brings higher crude arrivals into Dangote, as well as declining onshore crude inventories. Signs of Dangote gasoline production and ramp up are regaining strength. The total expected gasoline production is 300,000 barrels per day, so we will still likely have a ways to go, but operations look better than they did last month. Now, as we know, the startup of the Dangote refinery will back up more of the oversupplied gasoline into Europe. Declining destination outlets are visible in West Africa due to Dangote and to PADD 1 due to disappointing demand. As you can see in the right-hand side seasonality chart, volumes into the Atlantic coast fell sharply mid-summer to the bottom of the 5-year range. And although there has been some seasonal uptick in the last few weeks, it is likely a short-lived bounce for the Thanksgiving holiday. With the lack of gasoline outlets looming, we can see growing volumes of light distillates headed toward the Caribbean, likely for storage and blending. Now, the Caribbean serves as a beneficial logistical spot to store gasoline in the case of demand hikes in LATAM or PADD 1. However, if we look at Mexico's East Coast imports of motor fuels recently, despite the upward trajectory, the volumes remain at the bottom of the range, which is not good news for PADD 3 refineries that depend on the region for an outlet, especially for gasoline. Meanwhile, PADD 3 refineries have largely been depending on Europe as a diesel outlet this summer. However, as Europe looks to be well supplied with diesel, those volumes are beginning to soften. Europe has become a competitive battleground for middle distillates from the east of Suez markets and for the US Gulf Coast refiners. However, the decline in supertanker cleanups and a closed ARB due to an oversupply having arrived in Europe in October has redirected middle distillate flows more towards Asia than to Europe for now. Now let's take a quick look at the possible impact to Trump's re-election, and let's start with the Iranian trade. Although we have observed with the Biden administration designation a record number of vessels in the Iranian trade in 2024, despite these efforts, we've seen Iranian's crude exports average 1.6 million barrels per day in 2024, which is the highest level since US sanctions were imposed in late 2018. This raises questions as to how Trump could have an impact. Now, Trump could target the dark fleet VLCCs, which Vortexa currently tracks over 190 VLCCs, which are in the dark fleet, over 60% of which are non-sanctioned. However, in the long run, Chinese players' interest in discounted feedstocks could be strong enough to revive the trade with the implicit support from the government. Iran is in a different position to where it was 4 years ago and could respond to heightened sanctions by expanding the dark fleet, bringing in more non-sanctioned tankers into the trade. All in all, China is the deciding factor in what happens to Iran's crude exports, more so than the US. Despite record high vessel-specific sanctions in 2024, coupled with US efforts to target ports via the SHIP Act, China's imports of Iranian crude hit a record high this year. Now, moving on to more general policies. Trump has reiterated his support to drill more oil and increase US crude production. Any short-term increase in US oil production will more likely be driven by price incentives to drill, a direct function of demand and supply for crude, as opposed to policy measures. Despite declining global crude supplies in an environment of high geopolitical tensions, weaker demand prospects have kept a lid on global prices this year, which have been fairly range-bound for 2024, hovering within the $70 to $80 barrel per range. Therefore, the US increases production, resulting in higher exports of seaborne energy. It could likely place additional pressure on top of an already well-supplied market, pushing prices down, and even which could end up leading to lower production. According to the Dallas Fed Energy Survey, large exploration and production firms require a $58 per barrel price to profitably drill, compared with $67 per barrel for small firms. Now, considering WTI fell to around $67 per barrel at the end of September 2024, this suggests that demand will need to return in order to incentivize higher prices and therefore new and sustained production. Now, Trump has also promised a tax or tariff of up to 20% on goods from other countries and up to 60% on all imports from China. Now, the US does not import energy from China. However, it does import, although on a declining trend, from many places around the world. Now, any level of implementation of a tax on US petroleum imports would have huge negative consequences for the entire US oil production and refining industry, leading to higher product costs, inflation, and potentially more problems for the US refining industry. And although there is doubt as to whether this tax will be applied to petroleum imports, heavier crude grades and fuel oil are needed by US Gulf Coast refineries amid an oversupply of lighter domestic crudes. Over 44% of the total seaborne crude imports into the U.S. arrived to PADD 3 in 2024, mostly to feed U.S. Gulf Coast refineries. Fuel oil imports, which are 71% of U.S. imports discharged into PADD 3, mainly come from Latin America and the Middle East, serving as an important feedstock where it is necessary to run the secondary units at these refineries to optimize margins. A price hike to these important raw materials could force already struggling refineries towards economic run cuts or even closures. Now, that is all we have for you this month. Thank you for watching, and we hope to see you again on the next edition of the U.S. Energy Insights.